Welcome to the Trader's Arsenal, where you will find various helpful videos to level up your trading career. In today's episode, we will be discussing triangle patterns, which is one of the most common patterns that traders use as it is relatively easy to spot. These are the things that you will learn by the end of the video. We will be discussing the various types of triangle patterns, how to spot and trade a triangle pattern, and the golden rules to follow when trading such patterns. Do remember to follow us on our social media platforms so that you will always be updated whenever we post a video. Without further ado, let's get started. There are basically three types of triangle patterns: the ascending triangle, descending triangle, and the symmetrical triangle. Let's first look at the ascending triangle. Whenever you see an ascending triangle, it usually signifies the strength in buyers. So you should only be looking to long the market. Looking at the illustration on the right, you can see that the sellers tried to push price lower, but the buyers came in at this swing low to push price back up to the resistance area. The sellers then came in to push price down once again, but the buyers managed to step in to push price back up on this swing low. This went on and eventually the buyers won the battle and the price broke out of the resistance area in pursuit of higher prices. One way to identify ascending triangles is to look for a pattern where you see higher lows into the resistance area. In a typical uptrend, you will see higher highs and higher lows. For ascending triangles, there will not be any significant higher highs or lower highs, as the price will respect the resistance area. An important point to note is that ascending triangles or any price action patterns can appear anywhere on the chart. But if you want to capture explosive moves and have a higher win rate, you should only trade price action patterns near the support and resistance area. Some of you may wonder why. The reason is actually very simple. A support and resistance area is formed because the price tends to bounce off that specific area. Knowing that, most people will short near the resistance, or long at the support area in anticipation of the price bouncing off. Let's have a look at one example. Are you able to identify an ascending triangle pattern? At this point of the video, you should be able to easily identify this ascending triangle pattern here. Assuming there are two different individuals trading this market, Tom and Jack. Tom is a typical trader who loves to short near resistance and long at support in anticipation of price bouncing off. On the other hand, Jack is a price action trader who have identified an ascending triangle and is willing to go long if the price breaks out of the pattern. When the price approaches the resistance area, Tom goes short and places his stop loss slightly above the recent swing high. Jack places a buy limit order above the resistance area in anticipation of the price breaking out of the ascending triangle pattern. If the price breaks out of the ascending triangle pattern, this will trigger Jack's buy limit order. Since Tom set his stop loss above the recent swing high, when the price breaks out higher, his stop loss will be triggered and his positions will be closed for a loss. Remember, when closing a short position, you have to buy the security back. Hence, this will fuel further upside move, making it easier for Jack to hit his take profit target. Let's now look at the descending triangle pattern. Descending triangles are literally the opposite of the ascending triangle which we discussed earlier. It signifies the strength in sellers, so remember, you should only be looking to short the market when you see this pattern. The way to identify a descending triangle is by looking for lower highs into the support area. Let's go through one more example to recap what we learned just now. Let's say there is a descending triangle at the support area. We have two individuals trading the market. Tom, a typical trader, and Jack, a price action trader. When the price approaches the support area, Tom goes long and places his stop loss below the recent swing low. Jack places a sell limit order below the support area in anticipation of the price breaking out of the descending triangle pattern. If the price breaks out of the descending triangle pattern, this will trigger Jack's sell limit order. Since Tom set his stop loss below the recent swing low, when the price breaks down lower, his stop loss will be triggered and his position will be closed for a loss. Remember, when closing a long position, you have to sell the security. Hence, this will fuel further downside move, making it easier for Jack to hit his take profit target. Last but not least, let's look at the symmetrical triangle. The symmetrical triangle is slightly different from the other two price action patterns that we discussed earlier. Instead of having a trade direction bias, the direction of your trade is dependent on the direction of the breakout. Meaning to say, if price breaks out higher, you will enter a long position. If price breaks out lower, you will enter a short position. As simple as that. The way to identify a symmetrical triangle is to look for lower highs and higher lows where the price converge towards each other, forming sort of a triangle flag pattern. This price action shows the indecision between buyers and sellers at the same time. Hence, the price is just bouncing off up and down. Now that we have gone through the three different types of triangle patterns, some of you may be wondering how to trade such patterns. There are two ways to enter the market when you see a triangle pattern. You can either wait for the price to break out of the pattern decisively before entering the markets. Or you could set a pending order in anticipation that the price will break out of the pattern. Of course, there are pros and cons for each method, but we'll get to that later. Let's first look at the break and close entry method. For this method, you should wait for the price to break and close strongly above or below the latest swing before entering on the next candle open. To determine if a breakout is strong, look for large bullish or bearish candles. For example, if you are trading an ascending triangle, the breakout candle should be a large bullish candle looking like this. If the breakout candle has a small body or long wicks relative to the candle body size, avoid the trade. For ascending triangle, you should wait for the price to break and close above this swing high before entering. For descending triangle, price have to break and close below this swing low before you enter. And for symmetrical triangle, if price breaks and closes above this swing, you will go long. If price breaks and closes below this swing, you will go short. For entry using the pending order method, simply set a pending order slightly above or below the highlighted swings in anticipation of the price breaking out of the pattern. So, which approach is better? This is actually a question that most traders ask, especially if you are new to trading. Let's first compare the likelihood of you encountering a false breakout. If you choose the break and close method, it is less likely for you to encounter a false breakout, as compared to the pending order method. By using the break and close method, you will be able to decide whether to enter or not based on the size of the breakout candle, hence reducing the likelihood of a false breakout. As for the pending order method, there may be situations where the price will trigger your pending order before reversing back and closing in the opposite direction, forming a false breakout. Next, let's compare the profit potential for both methods. Let's say you are trading an ascending triangle and assuming the breakout candle is an extremely large bullish candle. If you only enter the market after the close of the breakout candle, you would have missed out on a huge chunk of the move. But if you were to use the pending order method, this would not be a problem. As you can see, there are pros and cons between the two methods. If you are a more conservative trader, you may want to go for the break and close method. But if you are a slightly more aggressive trader, you can opt for the pending order method. Regardless of which method you choose, stick with it and do not switch between methods. Otherwise, your trading results will not be consistent. As for your stop loss, you can set it a distance above or below the highlighted swings. When setting your take profit targets, you can either choose to use the width of the triangle pattern or the nearest major swing. Of course, there are many ways for you to set your take profit targets depending on your style of trading. The methods listed here are just a guidance for you to get started. You should always explore all options to find a method which suits you most and stick with it. Let's look at the first method. In this example, we are going to use an ascending triangle. The first thing you should do is to measure the distance between the first and second swing that occurs in the pattern. In this case, this is the first swing, and this is the second swing. So this will be the width of the triangle pattern. Using the width you have gotten, you can now project your take profit level starting from the breakout point. For the second method, we will be looking at a live example. Are you able to spot a descending triangle here? Remember, in order to identify a descending triangle pattern, you should look for lower highs into the support area. Here you can see lower highs into the same support area, forming a descending triangle. Sometimes it may be difficult to identify specific patterns at a glance because in reality, not all triangle patterns will look perfect. However, you don't have to worry as this will get easier with practice. For this example, let's assume we are using the break and close entry method. Using this method, when the price breaks and close below this recent swing low, we will go short on the next candle open. Based on the price action, this candle has broken out of the descending triangle pattern with a strong bearish momentum, closing below the previous swing low. Our entry would be here right after the breakout candle closes. Stop loss will be a distance above this swing high. Looking at the chart, the nearest major swing over here will be our take profit target. To determine if a swing is a major or minor swing, consider the following. If the swing is large and extremely obvious at a glance, it is considered a major swing. If the swings are small and not so obvious at a glance, it is considered a minor swing, and you should avoid using them as take profit targets. As you can see, the price did not hit our stop loss and eventually, our take profit target was hit. Looking at the two take profit methods that we discussed earlier, both are considered viable, but you should only choose one method and stick with it. If you are new to trading, you may want to use the first take profit method. If you are an experienced trader and is able to identify major swings correctly, you can opt for the second take profit method. Here are 3 golden rules that you should always follow if you want to be consistently profitable. First, always trade with the trend. Imagine you are climbing a mountain. Is it easier to walk an uphill or downhill? The answer is pretty obvious. It is definitely easier to go downhill when descending the mountains. When you are climbing uphill, the force of gravity is against you, making it more difficult for you to climb. When going downhill, gravity is pulling you forward, making it easier for you to descend. The same logic applies in trading as well. If the market is in an uptrend, it means the buyers are generally stronger than the sellers. A typical uptrend looks like this. Based on what you see right now, if you were to go against the trend and short the market, your profit potential is limited to the size of this retracement move, which is small. Whereas if you were to trade with the trend, your potential profits are much larger. Hence, always trade with the trend. To recap, if you are in an uptrend, you should only trade either the ascending triangle or symmetrical triangle. If you are in a downtrend, you should only trade either the descending triangle or symmetrical triangle. Next, you should only trade triangle patterns near the support and resistance area. This is something that we have already explained in the earlier part of this video, so if you missed it, you can pause the video and go back to the earlier part of the video again to revisit the example. Lastly, if you decide to use the break and close method, you should only enter after a strong breakout. This means that you should wait for a large bullish or bearish candle to show that the price has already broken out of the triangle pattern with conviction before entering the trade. This will reduce the chances of you entering on a false breakout and will in turn increase the chances of your take profit target being hit. If a breakout is weak, there is a high chance that it will turn out to be a false breakout, and that will be detrimental to your trade. So if you were to see a weak breakout, avoid the trade completely and move on to other markets. We have now come to the end of this video tutorial on triangle patterns. If you want to take your learning to a higher level, feel free to do this assignment we have prepared for you and send your screenshots to tradersarsenal89@gmail.com. If you have learned something from this video, we would greatly appreciate if you could help us give this video a thumbs up. For more video tutorials on trading, do remember to follow us on our social media platforms so that you will always be updated whenever we post a video. Thanks for watching.